Hi, and thank you for joining us here at Tax Talk UK, where we talk about all things tax and consider other important aspects of being self-employed, working for yourself, running a small business. So today we're going to talk about what happens to your assets or your stock at the point that you transfer from a sole trader trading style to a limited company. So before I do that, if I could please ask you to take a moment to subscribe to our YouTube channel. That way you'll easily be able to refer back to this information if you need to, as well as being able to navigate to a whole host of different topics that we have available, all aimed at supporting you in your self-employment. So back then to the question, if you change your trading style from a sole trader to a limited company, what happens to your assets, to your stock? How do you transfer those to the limited company? So the important thing to firstly to think about is that you have two separate businesses. So you have the initial business of you as a sole trader, and it's important to distinguish there that there's no separate legal entity between you and the business. So therefore, your personal items and the business items all belong to you. They're all one and the same. Then we have the second business, which is the limited company, the new company that is taking over from the sole trader. So this is a separate entity. So you have created a separate entity that is separate from both you and from your sole trader business, which are both the same, as we've already established. So you've perhaps been trading as a sole trader for a little while. You may have some assets, maybe some tools, maybe some equipment, maybe some stock inventory that you now want those to be accounted for in the limited company. So it's quite straightforward. If we go to the end result of what we're trying to achieve, so when you transfer your trading style from a sole trader to a limited company, effectively you are closing that business as the sole trader and you are opening the company. So when you close a business, you will need to discharge all of the assets and liabilities. So effectively that your sole trader business needs to end up with a zero balance sheet. So because you are a sole trader at this point in this trading style, it's not so important for things like petty cash, for bank balances, because they are yours and the same. It doesn't matter whether you use your personal account, or as long as you're correctly accounting for the business items. But the things like the assets, for example, are important still to correctly deal with those, because they will affect things like your capital allowance in your capital allowances, your balancing charges. So it's important that you correctly deal with each of those items on the balance sheet that has had an impact on your accounts, I guess, is the clearest way to think about it. And so some of these assets you may want to transfer to your limited company. Some you may not. You may just want those to become personal. You'll still need to deal with those. But however you deal with them coming out of the balance sheet, if they're transferring to the limited company, you deal with them almost in the opposite way. So your stock, for example, so ordinarily you would have a stock adjustment at the end of the year and say, I have £5,000 of stock. So then that would be reduced from the removed from the purchases element of the profit and loss for that year and included in the balance sheet. And at the point that you sold that stock, it would then be added back into the profit and loss for that relevant time period that happened and taken out of the balance sheet. So at the point that that sole trader business is stopping, for any reason, you still need to deal with that asset of the stock. It still needs to be removed from the balance sheet. So if you were closing your business completely there and you were scrapping any stock, winding it down and then scrapping anything that was left, you would then put the whole amount into the purchases for that final trading period, and therefore removing it from the balance sheet, so you'd have a zero stock amount on the balance sheet. Now, if you are going to want to transfer it to your limited company, then it's exactly the same as if you had sold it. So you won't therefore have the stock in your inventory on the balance sheet, but you will transfer it. So there's no problem with transferring it to the limited company at cost. And in that way, the simplest way would be to simply raise an invoice from your sole trader business to the limited company. That would give you a clear trail of what you had done and why you had removed that from the balance sheet, and then for the new limited company to then be able to claim the purchase expense of that stock at the point that it sells it. So you would effectively a simple way to transfer the stock, for example, from the self-employment, from your sole trader business to the limited company, would simply be to invoice them. But then it would be important to remember that would go onto the stock on the balance sheet of the limited company as the starting stock, perhaps. And in your sole trader business, it would still be important to take that adjustment out of the stock from the balance sheet to the purchases. And if you had sold the stock at cost price, then in the example of £5,000, the scenario would be in the sole trader business accounts, the £5,000 would be removed from the balance sheet into the purchases, therefore reducing the profit, and then the income from the limited company would go into your income. And so therefore on your profit and loss, you would have £5,000 income, £5,000 purchases, so no profit arising from that transfer in the scenario that you transfer it at cost. Of course, if it's below cost or above cost, it is going to affect your profit and loss, and that is all fine as long as it's all correctly accounted for. So in terms of the actual transfer of the actual finances, so for example, if you had £5,000 stock that you were transferring to your limited company, and you didn't have £5,000 in the company to pay that out, and therefore you didn't want to make the financial transfer, then that could simply be done through your director's loan account, which from other information and other videos where we've talked about the director's loan, you will know that is a way to account for personal money that's either in or out of the company. So you would then treat that as if you didn't pay the sole trader business for the £5,000 in that scenario, it would then be added to your director's loan, which would then be held on the balance sheet in the director's loan. And at the point that you are in a position to pay that money to yourself, then that isn't income, it's simply you repaying the director's loan. So hopefully that helps to explain with stock, for example, and it is the same principle with anything that you are transferring from the sole trader to the limited company. Just to add, with that scenario where we don't make a physical payment across, but we add it to the director's loan on the sole trader business, because you and the business are the same, then there's no need to worry about that. It wouldn't impact anything on the balance sheet when you're looking to close that sole trader business. So as I mentioned, it's the same principle for anything, any assets that you're transferring from your sole trader business to your limited company. Some things it may not be practical to transfer. For example, if you have a vehicle that's that you use for business and that's in your personal name, you may prefer to just claim the mileage that you use, because otherwise you would need to transfer the logbook into the company name. You would then be subject to benefits in kind if there's any personal use of the vehicle. So sometimes it may not be practical to transfer every asset. You may not want to transfer every asset. The important thing is for each asset to understand the implications of transferring that asset from into the limited company. Because, for example, with a car, so it's not the business as a sole trader, it's not the business that owns the car, because you and the business are one, so you can still own the vehicle in your name, and but it being used for the business and be in the business balance sheet. So it's just really important for each asset that you have in your sole trader business to consider what are the implications of having that kept in your personal name, and what are the implications of transferring it to the limited company, and make sure that you do fully understand before you actually go ahead with any transfers. It may be for some equipment that you have, perhaps if it's large, high value equipment and it's financed, then of course you need to consider whether the finance company is happy to transfer, and you know, so you may have some sort of abnormalities in the transferring over the assets. It's not as simple as saying, this is my sole trader business, I'm stopping this and I'm starting as a limited company, and therefore I'm just going to transfer it for everything like for like, because the limited company is a separate entity and it may not be practical, it may not be efficient, it may not be the best thing for you or your company to do. So it's important that on a sort of like by like basis that you ascertain what that asset is, what are the implications of transferring it. And of course, if you don't transfer an asset, but it has been, so say for example, if you have a vehicle, a business van, for example, that you've purchased and you've claimed capital allowances for, and that is on the balance sheet of your sole trader business, but you decide that you're not transferring it to the limited company, it still needs to be dealt with and accounted for as the sole trader business is closing. So you will still need to account for that at the current market value. So hopefully this helps to give you an idea of the things that you need to think about in practical terms with the assets of your sole trader business when you are transferring to a limited company. And as I said earlier, the important thing to remember is that you are closing your sole trader business and you are opening a limited company. You need to deal with each item on the balance sheet for your sole trader business, and if it is the right thing for you, then to transfer it to the limited company, and you can the limited company can either pay the sole trader business or you can account for it through your director loan. Obviously, I am talking about small micro entities, limited companies with just one or two directors. Obviously, larger companies would have other factors to think about. But as always, if you're not sure what the right course is for you, or you're not exactly sure on what you need to do, then that perhaps tells you that you should seek some professional advice. If you're seeking professional advice, make sure please that the person that you're seeking that advice from is qualified to give you that advice, that if appropriate, they are a member of a professional body and they do have indemnity insurance, professional indemnity insurance in place. So hopefully this will help you to sort of start to think about what you need to do in the transfer of your sole trader business to your limited company. Thank you very much for watching, and please do remember to subscribe to our channel. Thank you. Goodbye.